Right now, behind closed doors in Washington and Tehran, diplomatic movements are shaping parameters that will directly influence global energy costs next month and define how long central banks must maintain pressure on consumer purchasing power. The last 7 days have triggered a significant chain reaction across the global economy. While broader market focus remains fixed on headline volatility, such as the sudden correction in crude oil, Nvidia's exceptional earnings, and historic milestones in Japan, the underlying structural shift is often overlooked. In this analysis, we look past the media noise to examine the strategic economic pipeline, connecting global geopolitics directly to major currencies, international equity markets, and structural net worth. To understand where institutional capital is rotating right now, we must evaluate the core data. Let's begin with a major geopolitical shift. Recent Reuters reports indicating progress in US-Iran back-channel diplomacy. For months, the potential risk of a blockade at the Strait of Hormuz, the vital transit corridor for 20% of global liquefied natural gas and 15% of global oil, had kept international markets highly volatile. With Bloomberg intelligence confirming that interim transit frameworks are advancing, the geopolitical risk premium in the energy sector rapidly dissolved. Brent crude retraced over 10% in a single week, stabilizing near $93 a barrel. For international investors, this development carries broader macro implications. Crude oil functions as a primary driver of global trade. When energy prices undergo a sharp pullback, it structurally lowers forward inflation expectations. However, it simultaneously alters global capital flows. For resource-dependent nations and commodity-linked currencies, including the Australian dollar, this sudden drop softens international trade terms, demonstrating that lower energy prices often present a complex trade-off for broader domestic market strength. Meanwhile, across the Pacific, the final leg of the U.S. corporate earnings season outperformed expectations. Leading this momentum was Nvidia, reporting a staggering 129% surge in profits, confirming that global demand for artificial intelligence infrastructure remains highly resilient. This technological momentum pushed global indices forward, with Japan's Nikkei 225 index crossing an unprecedented 65,000-point milestone for the first time. However, this economic resilience functions as a double-edged sword. Because the U.S. economy displays persistent strength, the Federal Reserve continues to signal a higher-for-longer approach to interest rates, under minimal domestic pressure to ease monetary policy. This policy stance from Washington creates systemic ripple effects for central banks worldwide. Many are now required to maintain elevated domestic interest rates simply to protect their local currencies from depreciating against a dominant U.S. dollar. This structural fragmentation has created a distinct paradox within equity markets. While technology-heavy indices achieve historic levels, traditional sectors like energy and manufacturing are experiencing a pronounced internal capital rotation. As the 10% correction in crude oil impacts major energy equities, institutional capital is visibly rotating into two specific areas: defensive safe haven assets and high-growth artificial intelligence infrastructure. Gold, valued across multiple global currencies, continues to sustain near unprecedented levels, serving as a primary hedge against ongoing geopolitical friction. The fundamental takeaway for strategic capital allocation is clear. The global economy is experiencing a structural split. On one side, broader consumer sentiment remains constrained globally due to sustained borrowing costs. On the other side, institutional corporate profits continue to break records. This presents a unique macro environment where general economic indicators appear subdued, yet the structural pricing power of specific high-moat enterprises remains exceptionally robust. When navigating these macroeconomic cycles, historical data suggests a clear distinction between retail panic and institutional strategy. During periods of elevated geopolitical volatility, shorter-term market participants frequently react to daily price fluctuations. Conversely, market participants who successfully preserve wealth during macro shifts typically shift their focus entirely. This approach involves moving from shorter-term price chasing toward long-term value and sustainable cash flow accumulation. Geopolitical headlines and market volatility are historically transitory, whereas the underlying earnings power of high-quality assets remains structural. Observing the core data and focusing on long-term structural signals remains the standard approach for navigating these cycles. To continue building a rational, data-driven framework for understanding global macro trends and protecting capital in volatile markets, ensure you are subscribed to the channel, leave a like on this analysis, and share your perspective in the comments below. Until our next update, keep focusing on the signal over the noise.